When unprecedented events happen, such as a bank failure, our emotions and reactions are based on our interpretation of what has happened. Let me share the Kevin Martini facts with you. This is episode 175 of the Martini Mortgage Podcast. I'm calling it Bank Failures, what really happened and what is happening. But before I get deep into this very important episode, I need to make the legal folks happy. So, my name is Kevin Martini, and I am a certified mortgage advisor and producing branch manager, NMLS 143962, with the Martini Mortgage Group at Gold Star Mortgage Financial Group Corporation, NMLS 3446, equal housing lender. The primary purpose of this podcast series is to inform, entertain, and educate. The information, opinions, and recommendations presented in this podcast series does not constitute legal or other professional advice, opinions, or endorsements of any kind. Okay, with that said, let's deal. As a primer, we have to start with how the banking system works. Very simply, the banking system works with OPM, which is an acronym for other people's money. Let me share a high-level illustration with you of how it works. You deposit money into the bank, say $100,000. The bank says they're going to give you 0.5% interest on your money. That means you will make $500 in this example. To you, the deposit is an asset. And to the bank, your deposit is a liability because they owe you the money. Now, that bank has to do something with your deposit to pay you the interest and to ultimately make a profit after all their expenses. To make a profit, they use your money to lend to other people and to invest. Now, because of regulations, they cannot invest 100% of your deposits. They have to keep some cash reserves in the vault. So for illustration purposes only, let's say it's 10%. 10% is required for reserves. So $10,000 of the deposit that you made in the cash of $100,000 to the bank has to stay in their vault. And the other $90,000 the bank takes and hustles to make money with it. I am not saying that this is bad, folks. I'm just highlighting what they do. Remember, the bank pays your interest of 0.5% on your deposit. And to do this, they have to do loans to other people. They make interest on those loans, and they also have to invest. Now you have a synopsis of how the banking system works, and it's very important to understand. Before I share what's going on in creating the pressure on the banking system, there is one more thing you need to know and have a high-level understanding. You need to know how bonds work, because that is the secret sauce of what is going on today. Bonds have a face value or par value. In other words, what it is worth at maturity. So if the bond has a par value of $1,000, then at maturity, the bondholder will be paid $1,000. Pretty simple so far, don't you think? Then the next thing you need to know is that a bond has a coupon rate. Very simply, this is the interest rate the bond will pay. So for illustration, let's assume you have a bond with a par value of $1,000 and the coupon rate is 4%, then you will make $40 a year of interest through maturity. Now, bonds trade every day just like a stock. Actually, the bond market is actually larger than the stock market. When trading bonds, they may be trading at a premium or they may be trading on a discount. It's all based on where interest rates are. When interest rates go up, this results in a decline in the value of the bond, and the bond is traded at a discount. Holy cow, that was a lot. So let me go ahead and say it another way. You purchase a bond with a par value of $1,000 and it has a coupon rate of 4%. Let us assume that the interest rate increases from 4% to 5% in the market. This would cause your bond to drop in market value and it would be trading at a discount. For example, an illustration only, if the market value of when you purchased a bond was $1,000, it would likely be worth $900 if you sold it today because of the change in interest. If you did not sell it, then you would still make your coupon rate every year and get the face value return. But if you sell it before maturity, you're going to take a haircut. Woo! That was a lot. So now I have it all set up. So let me share the punchline. What is happening with the recent bank failures at a high level? This is it. They took your deposits, and yes, they did some car loans, but they also took a ton of money you deposited and put them into fixed assets. Oh, by the way, bonds are fixed assets, but they're long-term fixed assets. Now, you have seen that everything costs more, and you have realized that you could be making 4 times the return on your money someplace else other than a bank deposit where you're getting a return of 0.5%. And you go to the bank to withdraw your money to put it into another investment with a higher rate of return than the 0.5% the bank was paying you. Nothing wrong with that. It's smart. Remember, the bank only keeps a small portion of the amount you deposited in liquid cash in the vault. The rest they put to work in long-term investments. The challenge is the banks invested in very smart, very safe fixed assets, also known as bonds. And they did not keep their eye on the ball. Well, in my opinion, they actually fell asleep at the wheel. So to give your deposits back, they had to sell these bonds, and these bonds are trading at a discount. To exaggerate, the bank purchased them for dollars, and now they're worth pocket change. Hence, they took massive losses to sell, and after they sold, because they had to sell at a discount, there was not enough money to pay out everyone. Hence, the run on the bank, just like we saw in that Christmas classic, It's a Wonderful Life. What a great movie. Anyway, what they have done, in my opinion, is malicious malpractice because they have turned a very safe, fixed income asset into a toxic asset because, well, let me just be politically correct and say incompetence. With proper, competent fiscal management, this all could have been avoided. Listen, there's nothing wrong with fixed assets. There's nothing wrong with bonds. They just have to be managed in a portfolio. Listen, I have 2 standard poodles. One is named Raleigh and the other is named Louie. And they both knew the pace of interest rate hikes was unprecedented, and they even rebalanced their portfolio. In the past 12 months, the Fed has raised their rates by 4.5%, and that is the fastest pace since the 80s. How the banks did not see the trees in the forest, I have absolutely no idea. Again, let me be PC and say it was incompetence. as Bugs Bunny says, that's all, folks. But wait, there's more. The first thing you need to do right now, I mean today, is make sure where you bank is FDIC insured. If you're with a credit union, make sure it's NCUA insured. If your deposits are up to $250,000, you will be protected. Now, if the assets in your bank are greater than $250,000, then you have to be proactive right now. Again, today. You need to reclassify those deposits within the bank or credit union, or slice and dice your assets into multiple institutions with balances under $250,000 and make sure those institutions are either FDIC insured or NCUA insured. In closing, let me share two really quick things. Number one, what is happening with these bank failures is a deflationary event. In the simplest form, that means the cost of goods and services will decrease. As inflation turns into deflation, mortgage rates will go down. And number two, when mortgage rates go down, homes become more affordable and more attractive to home buyers. Deflationary events with homes being more affordable are very critical nuggets to keep top of mind, especially since I know money is made when you buy real estate, not when you sell. Right now is the time to buy if homeownership is right for you. Remember, if it's right for you, and if you want to explore your homeownership options, let's connect. My name is Kevin Martini. I'm a certified mortgage advisor with the Martini Mortgage Group, and I'm located in Raleigh, North Carolina. However, I help families all over the U.S., and you can reach me by dialing 919-238-4934. Looking forward to connect. Stay safe out there, and wishing you peace and blessings.